And to talk more about the fact the markets in the U.S. are closed for the holiday and other options, our next guest says increasing non-U.S. investment will strengthen your portfolio resilience and long-term outcomes. Let's welcome Rhynhardt Roodt, Global Equity Portfolio Manager at 91. Rhynhardt, thank you very much for joining us.
Hi, Roger. Lovely to be here.
What do you like to see as a balance when you're looking outside of the U.S.?
Look, I think if you're looking at investing outside of the US, the question is always profit growth. I mean, it's been really one-way traffic for a number of years, right? I mean, the sheer dominance of the US market, not only really because of the big tech names. Obviously, tech earnings have done significantly better than the broader market, and that continues to be the case today. But if you go outside of the US, you are looking for different types of exposures. You know, market structures are quite different. You know, if you look at Europe, it's got much more energy, more materials, more industrials, more cyclical financials, and like emerging markets, you know, greater or higher growth consumer exposure. But what gets you to invest outside of the US is ultimately access to diversified earnings and different streams of earnings. But obviously that earnings has to keep up with what's available in the US, which obviously explains why the US has done very well relative to many other regions up until this year.
And let's stay with the European for a second here. Banks, industrials are one of the areas you have interest in. Any concerns right now with what is unfolding between Ukraine and Russia? The idea that there may be a settlement, or it may continue.
Look, I think at least in the near term, it seems like a ceasefire is likely. Clearly, you know, we get new information on a daily basis, so who knows where it will end up. I think what takes a step back, though, I would say that on a multi-year basis going forward, I think Europe has woken up. I think Europe realizes that they need to increase the level of GDP spent on defense. I highly doubt that is going to change, and I think the percentage that they will be spending on GDP will be at least at the level set out, or maybe even increased. So I think, you know, one kind of has to take a slightly longer term view beyond the shorter term gyrations, and you know, it's very plausible that one might in fact see like a ceasefire. But if anything, I think in the sell-off of some of those related sectors, such as European defense, for example, that might actually say provide quite a good buying opportunity.
And just going to jump over to Japan. You've expressed interest there, but there's a lot going on right now there, isn't it?
Yeah, it is. I think the key change in Japan is really just the rise of inflation. It's obviously an area where there hasn't been inflation for a long period of time. So it's interesting to see how companies and businesses say cope with that, the ability to pass on price increases for the first time, and that is presenting quite interesting opportunities. And then there's also corporate reform. I think a lot of Japanese corporates have been very conservatively managed, have hoarded quite a lot of cash on their balance sheets. So it's quite pleasing to kind of see them becoming somewhat more investor or shareholder friendly and redistributing some of that cash back to shareholders.
And any concerns about potential rate increases there from the Bank of Japan?
Yeah, look, I mean, that's bound to happen. It does seem like the Bank of Japan is somewhat behind the curve, like a bit, which obviously does explain some of the weakness in the currency. But I think that is very much the path of travel. The Bank of Japan seems to have done that in quite a measured way, which is always good to see, and that gives the consumer and businesses, you know, kind of like a bit of time to recalibrate and deal with a higher interest rate environment.
And part of the success for the markets outside of North America, outside of the U.S., the weakening of the U.S. dollar, where do you see that heading in the coming year?
Look, it's always hard to call the level of the currency, but you know, when currency shift starts happening, it tends to last quite a long time. So currency cycles can be multi-year in nature. And it's safe to say that we have just come out of a multi-year US dollar bull market. So, I mean, while I'm probably not in the camp of rapid, you know, US dollar depreciation, I do think there's a case to be made for for a dollar cycle that is less strong than the one that what we've seen previously. And markets are made in the second derivative, so it's often the rate of change that kind of matters more than the absolute level itself, and that's why it's kind of easy to kind of see why investors are looking beyond the US. Not only because of potentially more revenue growth opportunities, but also that the currency tailwinds which they might get from potentially a less rampant US dollar.
Okay, and then just to bring it back full circle to the American markets, which are closed today, where does that leave the markets heading into the new year, do you think?
Look, it's been a really strong year, clearly. Broadly speaking, returns have been quite robust. And obviously the US market has participated in that. I think it's interesting if you look at market structure. Obviously big tech is a large say percentage of the US market in particular, but on a look-through basis, broader tech and AI beneficiaries as a percentage of the overall market index is probably at its highest in the US, which has kind of helped it. But it's at the same time, it's interesting to see that other markets have in fact kept up with that. So, I mean, we're of the view that corporate profit growth looks quite resilient. I think at the moment, earnings season looks quite solid, and on balance, I think more companies have beaten earnings than kind of missed. So we are reasonably optimistic into year end.
All right, we'll wrap it up there. Rhynhardt, thank you very much for joining us.
Thank you very much.
Rhynhardt Roodt is Global Equity Portfolio Manager at 91.